Okay. So as always, standard disclaimer. Okay, whatever I mentioned today, we please don't take it as financial advice. Some of the strategies here are not applicable to a lot of you. Some of them may be applicable down the road. We don't really know, but these are all strategies that go beyond what most people think about when they think about insurance. Some of these strategies you will have heard of them. Some of these strategies you will probably end up scratching your head after the end of the session. But that's also normal because when I first learned them, I was also scratching my head. So it's very normal. But definitely some food for thought, I think, at the end of this session is that what insurance really can do for you, because some of the strategies here, I am very sure that in the hands of the right person, it will be a very useful policy to have. Okay. Okay, so without much ado, I think most of you know who I am. Okay, you all probably gone through the course already, and I won't say too much about that. So let's get started tonight. Okay, on special module, advanced insurance techniques. So I'll discuss a couple of things. um, Generally, I'll be able to answer questions if time permits. At the same time, I also have catered some time at the end for Q&A. If we run out of time, then yeah, we can have coffee lah if you have more questions. Okay, so tonight's session really just a sharing of the things that some of you may or may not know. Though I'm very sure the last one will be quite new to most of you. Okay, uh, yeah, that's all really. Okay, so I also had to scrap a few things from what I wanted to say. I do apologize in advance because I know we did talk about covering freedom funds, but I look at the grand scheme of things, and I think freedom fund is something that I may touch on if I have time, but in the interest of covering more abstract strategies, I actually have just parked that aside lah. Though this time I will revisit it. Actually, we also left out quite a number of things. Originally, I had like 7 different things I wanted to share. We chopped it down to 4 because of time constraint. I have 60 slides lah, so that's why there's not a whole lot of time to share everything in 2 hours. Okay, having said that, so we did talk about giving an unfair start for our children. I think that's one thing that as parents, if you're a parent, you would probably want to be able to give that unfair start to your children. And of course, this was also covered in module 2 of the class, insurance policies. I did cover basic types of insurance policies. But of course, then I always get this question, what kind of policies should people get for children, right? So I think it's quite clear that most parents would definitely buy a hospitalization plan for the kid, and I think there's nothing wrong to that. In fact, I'll be surprised if you didn't, because hospitalization, especially in the case of Singapore, I think we know that it's very, very expensive. Okay, and of course, kids being kids, there's a lot of reasons for them to end up in the hospital, right? For now, hand, foot, mouth, dengue, things like that. A lot of things can end up in the hospitalization. So definitely hospitalization is a must. But then, what other head starts can you give your loved ones, right? And for that, the next one, which I always feel is more important than, not say more important, just as important, I would say, as hospitalization, would be getting your children a critical illness policy. Now, you may ask, why critical illness? Okay, it's very, very simple. A couple of things here. When the children, when your kid is growing up, okay, when your kid is growing up, if something happens to them, okay, they are definitely not in the position to fend for themselves. Okay, if let's say leukemia strikes, which is technically a cancer, uh, so who's going to bring them for treatment? Okay, it's the parents. So if the parents have to do that, then they have to take time off work. They have to be there with the kid. And we even had seen cases where parents quit their job to actually give their sick children the time needed, and of course the attention lah, when it comes to treatment, all that. And that comes at a cost to the family. It comes at a very big financial cost, because if one parent out of 2 quits working, you can see that easily the family income will drop by anything from 30 to 60%, depending on who quit, right? So how do you compensate for that kind of financial loss? That's where this kind of critical illness payout will give the family money, so that maybe even both parents can quit the job for a while to look after the kid. Okay, so this kind of critical illness policies is really something that I think should be considered, and you'll be surprised it's actually not expensive, given what it covers. Okay, on top of that, one thing I would say for sure is price one thing, but insurability is the more important factor. So what is insurability, right? Okay, so insurability just means that if you're applying for a policy and you answer all the questions in the questionnaire, and the insurer says, okay, we'll cover you, just make the payment and we can start, that means you're insurable. Okay, so insurability is far more important reason that you can, or you should, or you can get coverage for your kids when they are young, because generally speaking, we get more and more unhealthy as we age. Okay, so a newborn is definitely at like the healthiest, like, if you get what I mean. So insurability is actually the number one reason you should get your kids a CI policy, followed very closely by the fact that they're young and it's of course cheaper at that point. So I have two case studies that I like to share, and I hope it gives you some food for thought. The first one is lupus. Lupus is an autoimmune disease, and it actually affects, I think, predominantly females. So I had this client, this was about 8 years ago, and she wanted to get a policy, but then she told me that she has lupus and she's not sure uh, what that meant for her. So of course I went to ask around underwriters and all that, and they basically say lupus was basically their sentence lah. Uh, she couldn't apply at all. Okay, every single insurer rejected her. Now the good news is that her father saw fit to buy her a CI policy when she was young. In fact, it was the famous NTUC living policy, which some of you may have heard of. It's an NTUC living policy that they bought when she was, I think, 2 or 3 years old. And the coverage wasn't a lot, it's only about 50,000. But till today, that is the one and only policy that she can fall back on in the event of a critical illness. Okay. So just for perspective, she was only 18 years old when she spoke to me. Okay. So yeah, 18 and she's completely uninsurable forever. Okay. Second one, heart defect. I have once met a young guy, young chap, 20 something years old, and he's born with a certain heart defect that just basically made him uninsurable from young. Okay, so the moment the heart defect was detected when he was very young, he's basically uninsurable, which also means cannot get anything, right? So I said uninsurable. So the thing here is this, nowadays there are some ways to close the gap. Okay, one of them is maternity insurance. So that's why you may see it getting more popular. We didn't cover this during the class, but maternity insurance basically, if you're going to get it, most people think of it as covering for pregnancy condition, right? And congenital illness of the kid. But to me, by far and away, the most important thing about maternity insurance is that you can use it to get a whole of life CI cover. Early or late doesn't matter, although I think early will make more sense. A whole of life CI cover before the kid is even born. And then when the kid is born, even if the kid has some health issues, this whole of life CI cover can be then transferred to the kid without underwriting. So if that client of mine, when he was born, of course maternity did not exist back then, but let's say it did, and the parent had bought a maternity insurance, okay, and he was born, discovered this heart defect, he still can have a whole life CI cover by transferring the maternity insurance, which covers the mom first, okay, onto him. Okay, so basically the maternity is a 2-in-1 combo of maternity plus whole life CI. So it's the whole life CI portion that is transferred to the kid. So this is something that I think nowadays people are wising up. So I think that's good. I even had a client earlier this year bought a maternity insurance for herself with the whole life cover, and the kid was born, it was 300,000 whole life cover, okay, early CI. And then after that, 14 days later, she said, I think I better get more before they discover anything. Not that not that the kid is unhealthy or what, like, it's actually a very healthy kid. And then she bought another 300,000 ECI cover for the kid. So total kid, the kid can't even, I think the kid can't even walk yet, can't even crawl yet, 600,000 ECI cover. And the premium is actually very low for 600,000. It gets covered for life. So this is the kind of head start I think you want to give your children, knowing that if something happened to them down the road, you have made those provisions for them, that, there's money there. Okay, there's money there if something happens to them. So then the next question people have asked me is, then do I get a term of whole life? So I'll just answer it with one very simple question. Oh, sorry, one very simple, two very simple pictures here. This is a quotation. Okay, Ray asks, we say premium low, how low is that number per month? Okay, so it varies depending on how much coverage you want, but actually I got two examples lined up, so Ray, you'll be able to see it right now, okay? So, your father, 30 years old, wants to buy a term plan covering just late CI. We won't talk about early CI yet for the kid, okay? It costs 456 a month. Sorry, 456 a year, okay? 456 a year for 70 years, okay? So, think about it, do you do a term or whole life for kids? So you did this via a term. This very term here, which is more or less around one of the cheaper ones on the market. You will be paying a grand total of about 32K. Okay. And there's a very big risk. What's the risk? The risk is that in these 70 years, all it takes is you miss one single premium and the whole policy will lapse. And the policy lapse, you don't really stay in time, which can happen. You will have to buy a new policy, and by then the kid will be older and the premium will be higher, and he might not even be insurable anymore. So sometimes we need to be very aware that even if the premium seems low, you're paying it for 70 years, it won't be low in the end. Okay. So now going to the question of Ray, from Ray, which is like, how low is it? Okay. This is a whole life covering the exact same 500,000 CI cover as the previous slide, this term plan. Okay. What's the difference? The difference is, first thing, of course, the premium is payable only for 10 years. So the person, this father, will pay 32.6K. So that's $600 more than the term plan. But what's the trade-off? The trade-off is very simple. The trade-off is that once he's done, he's done. No need to pay anymore. So the kid haven't even cleared PSLE, already got a CI plan covering him for the rest of his life. On top of that, okay, remember 500,000. So okay, I mentioned this during the class. What's a life plan with multiplier? Those of you remember, the life plan with multiplier is basically 500,000 CI cover, and after a certain point in time, okay, in this case, actually age 70, it will start to drop. Okay, I'll show you the chart later, but basically you're paying about the same amount of premium as the term plan, and your coverage, the remaining 100,000 base cover, is for life. I don't think that's a bad deal at all. Now, I thought that, okay, we talk about cost. This works out to be, well, okay, I didn't check, but let me see. This is, I think, $270 a month. Okay, this $270 a month for 10 years. Okay. I understand that milk powder is already $200 a month, okay, for the mid-tier brand. So basically, okay, if someone is trying to compare $456 a year versus 3,259 a year, okay, and all I can say is this: if paying this instead of 456 is going to be causing financial stress, I think honestly the real problem is not the plan. The problem might be your job. You might be underpaid, honestly, because the extra 2,000 plus dollars a year, we're not even talking a month, we're talking about a year, 2,000 plus dollars. Honestly, yeah, that should not be a cost for a point of concern. Okay. Uh, one number may seem high, 3,259, but in reality, it's actually, it's not about what you pay, but it's the value you get from this. Okay. So if you tell me that 456 a year is better than 3259, I think your boss is underpaying you by a lot. If that $2,800 really make that kind of difference to you. Okay. So term versus whole life. So going back to what we said, okay, a coverage on a term plan basically ends at 70. Okay, you paid that 32,000 if nothing happens. Okay, you don't lapse all that, no payout. That's it. It ends at 70. But for a life plan, I think most of you are familiar. As the base coverage is there, 100,000, and the cash value slowly grows up over time. Okay, so even after 70, your kid probably is covered for anywhere from 2 to 400,000. And what do you pay? 30,000, 32,000. Okay. Yeah, if you think that's not a good deal, then I really don't know what to say, because this is probably the best deal in terms of actuary science when it comes to this kind of coverage. Okay, so that's the kind of head start that I think most people want to give their kids. Okay, and then the next thing, the most common, one of the more common ones also is, how about education funding? So education funding, we didn't talk about a lot about it, but over the years, it has also evolved. Okay, so last time we used to have, oh, you pay money and it matures when the kid is 21 or when the kid is 19, depending on if it's a boy or girl. Nowadays, times have changed. Uh, Education funding is now sustained via what we call indefinite maturity plans. The technical way of looking at it is whole life endowment, but I just prefer use the word indefinite maturity so that it's more obvious that the maturity date is not fixed. Yeah, I say whole life endowment, I think now you will really be able to grasp what it is, I believe. So there we have it. So how does education funding work for kids? Honestly, I don't think it's very complicated. Really, you just need to set aside some money. So in that example here, is that all, by the way, all the plans I'm showing you so far, they're all real quotations. I basically generated them today just to make sure that these plans still exist. Okay, so all these quotations are real. They are actually pretty they're basically available in the market if you're looking at it. So let's say education funding for children. Okay, most important thing to know is that nowadays plans are getting better and better. They have to be, right? So you realize one thing, by the time you finish paying 30,000, the policy is also capital guaranteed, which I think is about as good as it gets. Okay, and the question really is, when does your kid need the money? So usually you let it grow, but notice one thing, usually around 20 years in the future, give or take a bit, the value of the plan will have then increased to a point where you have the option to partially liquidate and then use it for education. Now, you don't liquidate how? Okay, is it possible to not liquidate? Answer is also yes. Why? Because what, your kid got a scholarship? So even your kid get a scholarship, the important thing to know is that with an indefinite maturity plan, okay, your plan will just keep growing all the way. This one goes until age 125. Okay, so indefinite maturity plan will definitely beat fixed maturity, because if a fixed maturity plan matures and your kid has a scholarship, the money just go back to the bank account and earn, well, practically nothing. In indefinite maturity plan, you are keeping the resources for your kid within the confines of the policy, meaning that the policy will continue to grow it at usually inflation plus a bit more. So this is usually around 3+% coming in on the good ones at 4%. Okay. So you don't, it relieves you of the burden of trying to figure out what to do with the money if, let's say, you don't need it. Okay. And more importantly, okay, two more important things. You can only buy a policy if you are an adult. Okay, the insured doesn't have to be an adult, but the owner of the policy has to be an adult. So this also means one thing. Okay, the money is actually still yours. The money is still yours. It means that if you don't want to tell your children that they have um, preparations made for their further education, you can choose not to do so. And this may actually make your children work harder. This is what someone told me, but I think it does make sense. Okay, if they didn't know that their path was already all set up, so you still own the policy, the money is actually technically still yours because you have full say over the policy. As long as you don't vest it to your children when they turn 21, this money is actually your money. So no harm anyway, right? Okay. So that's how I will look at it. But the more important thing, other than the fact that you don't have to let your children know about this policy, or the fact that you don't have to manage the growth of this, okay, because, well, it's the insurance managing for you. The more important thing is that education funding policies, or basically indefinite maturity policies, often allow you to add one very critical thing, which is called a waiver. Okay, we never really explain waiver during the class, so I explain it now. A waiver just means in the next 5 years, while you're paying this $6,000 every year, if something were to happen to you, okay, and that something can be death, CI, depending on how you set the waiver up, okay. If let's say you pay the premium for 1 year, and then something happens to you, you trigger the waiver, the remaining 4 years of $6,000 does not need to be paid. Okay. Ray asked, thought child reach age 21 auto vested to them. Okay, this one depends on the individual insurance policies. There are some policies that do not auto vest. I've come across them. And then there are also some that auto vest, in which case you might want to prepare to inform your children that they are in possession of a sum of money that should be used wisely. Okay, Ray? The income policy, okay, really it depends on the individual policy. Okay. I remember I have one client who has a income living policy that on the kid, and the policy did not vest to the kid. I can't remember why, but yeah, it didn't vest. Kids working already, so it's not a matter of age. But anyway, okay, coming back to the waiver, okay, if you are going to say that, okay, so let's come back to the debate that's always saying that, should you use endowment or should you just go invest for the kids' education? If you're investing for the kids' education, if you suddenly die after 1 year, that's it. What you put in 1 year of $6,000, let's say both sides you invest 6,000, okay, versus you put aside money in a endowment. You invest 6,000, after 1 year, you die. That's it. There won't be further funding to grow this investment fund to create that money for your kids. Okay. But if you have a waiver on a endowment like this, the policy continues as planned, meaning all these numbers will continue to hopefully come to fruition. Okay. So if you're investing, you put 6,000, you die, that's it. No one's going to manage your investments for you. Maybe your spouse may not be good at it or not keen on it or something. And then there goes your dream of wanting to grow money in the markets to, fund your children's education. With a waiver on our education policy like this, okay, the remaining 24,000 does not need to be paid. Everything will continue as planned. So waivers are actually very important because they ensure that the original intent of the policy will be fulfilled by means of the fact that it will be funded through, even if something happens to the policy owner, it will be funded all the way. Okay, so I think this waiver should not be underestimated, and I think the exceptions would be, for example, if all the money is already available for the policy, then you don't need a waiver, just put the money in. Okay, or or if let's say your money is more or less there and you're not paying over too many years, maybe like 3 years, unlikely you need a waiver, right? But for people paying over 5 years, 10 years, a waiver can be a very good thing to have. Okay. My history doing this, not my client, or rather my client, but not bought from me. I know that was one client whose husband passed away, and he was the one footing most of the insurance premiums. And without a waiver, okay, and the premiums were not small, but let's just say without the waiver, the burden of footing the premiums fell onto the wife. Okay, fortunately, the wife is also a relatively high income earner. Okay, so it stretched her a bit, but she managed to see things through. But the waiver really could have saved their family because she will be free from, she wouldn't have the sudden extra premiums to pay. Okay, so you see where I'm coming from with that. Okay, so that's something that I think uh should be considered lah. Okay, okay, this one is a bit more for people who have who wish to really create this kind of sources for their children. Okay, I call this an opportunities fund, but I think most of you really know what it is. This is a 50-year-old father to a 2-year-old, 1-year-old, sorry, 1-year-old daughter. Okay, okay, I have to say he is doing well in his career, but what he wanted to do is that he told me that he wants his daughter to have the ability when she turns 18, but not any earlier than that. Okay, when she turns 18, to have the ability to try to do the things she wants to do. If she wants to do a startup or open a cafe or all that, she must have capital. Okay, I said, okay, great. Then what do you want to do to achieve that? And he said, I want to create opportunities fund for my daughter. Okay, so for 10 years, he sets away 20,000 a year. And when his daughter turns 18, okay, she'll get about 12,000 a year to do whatever she wants to do. Well, if she doesn't know how to be an entrepreneur, then nothing can be done. But if she does, okay, this kind of money allows her to try and try again. Try and fail and try again and fail and try again and fail. I think a lot of people may be faced with the fact that when you're trying to do entrepreneurship, okay, I think sometimes there is that fear that if you do not succeed, then where will you go from there? Okay, you may have just borrowed money, do something that didn't work out. Okay, but in this case, the daughter would have some seed capital to do things every few years and see whether things work out. So can you imagine every 5 years she wants to try a new business idea? Okay, in 5 years, this kind of money will come out to like 50 over thousand, which is a reasonable amount of money to try out a new idea once in a while and see if it works. Okay, so this kind of opportunity is fun, can be liberating for your children. Okay, I think it's actually something that may, well, encourage them to go beyond just a 9 to 5 job. Okay, so this is just something that not many parents are doing, but this one is at least. Okay, so something to think about there. Okay, so that's giving your children a head start. Any questions on this part other than the 2 questions from Ray? I'll drink some water first before I lose my voice. No questions? Okay, we're going to the next one, which is leverage insurance. And definitely we didn't talk about this in the class. Okay. Okay. So leverage insurance is basically a strategy where you do leverage, and most of the time leverage people will think about house. Okay. But it's not very it's there are similarities. Okay. So leveraging just means that you're buying something without paying everything for it yourself. Okay. You borrow money instead to pay for it, and then you repay the money to whoever you borrow from. So we go back to the basics. What is financing? Okay, so financing is basically where you basically get money from some provider. Okay, so the provider provides you the funds for business activities, purchases, or investing. Okay, so we all heard of things like margin for investment and things like that. That would be actually be investing. Okay, businesses borrow money from the bank all the time to expand their businesses. That's business activity. Okay, but making purchases, this is where premium financing falls into. So before we talk about the specifics, I would just say that this question has always been around: is financing good or bad? Okay, and I would say it's neither. A lot of things to consider. First thing is what rate you borrow at. Okay, can you service the replacement? I think this is one of the very important questions to consider. And then, what's the purpose of the borrow fund? Are you borrowing to play, or are you borrowing to invest? I'm not saying invest, but like buy an asset instead of like spending it on, I don't know, a holiday or something. Okay, so this is what I think we need to understand. Financing itself is not the problem. The problem is what do you use to borrow money for? Okay, so generally there's good and bad debt, as we always know. Okay, financing for things like a mortgage is generally good because rates are generally, I wouldn't say, okay, now it's low compared to like a couple of years back, but generally it's definitely not in the range of, for example, credit card debt, right? That kind of debt is very bad. You should clear off, okay, because the rates are very, very high. Okay. So most of you who have financed before, right? Because as long as you ever borrowed money to buy a house or buy a car, or take a loan for your kids' education. If you're a business owner here, you borrow money to a business expansion, you have finance. Or I'm sure this also happens once in a while. At some point in your life, you probably forgot to bring a wallet to work and you have to borrow $10 from your friend to eat lunch and pay back later. That is also financing. Okay. So being able to borrow this money is one thing, but the question I want to ask is, why did the bank or your friend or whoever lend you the money in the first place? And it's very simple. It's based on the fact that you can pay back. Okay. If not, it's as good as a donation, right? Okay. So if you are taking a housing loan, the banks will assess your income, credit line, same thing, income. Okay. And that is when you have not only they know that what is the purpose of you borrowing that money, they know you can repay the money in a reasonable time frame, but they also know that if for whatever reason you don't repay the money, there is a collateral. Okay. And this is called asset-backed financing. Okay. So housing loan, your house is collateral. Car loan, your car is collateral. Lunch money loan, you are the collateral lah, but you don't pay back. I don't know what happened to you lah. Okay. So, but you don't pay back. Okay. So yeah, this is what happens lah. Okay, you don't pay my housing loan, the bank will stop. May foreclose your house, seize it from you. Credit line, okay, you had to declare bankruptcy. I hope never gets to that. Lunch money, you don't pay back, your friend just stop talking to you lah. Okay. So there's always consequences for not paying back the loan, which also means that when you borrow money, well, indirectly, whoever's lending you the money is assessing you on the ability to pay back. Okay. So that's borrowing money for lunch, for house, for car. What about buying a policy? Okay, so you're buying a policy basically through financing. You are taking out a third party loan to pay for the premiums. Okay, so whoever lend you the money will charge you interest. Okay, this interest rate is usually floating, and the interesting thing is, um, there are various ways to pay off the loan. Okay, you can pay off just the interest, or you can arrange to pay off the interest and at loan renewal pay part of the principal. Okay, these are generally these two accepted methods of clearing the loan. Or you can choose just to pay interest, as I said. In that case, you are very well aware you are not there to pay off the entire loan. You're just there to finance in perpetuity. Okay, so who is financing suitable for? Very simple. If you are not in the position to liquidate assets to buy a policy that you are looking at, financing is an option. Okay, if you want to increase the size of your portfolio, but you don't have that amount of capital, financing can give you the capital to increase the size of your portfolio. Okay, very importantly, I also need everyone to understand there are pros and cons to financing. You must be very comfortable with them. The banks will definitely talk about financing to you at some point or another. Okay, because I've seen a lot of that already. Okay, and of course, you must be someone who's comfortable to make use of debt. Okay, there's good debt, bad debt. Financing done properly is good debt. Okay, but if you are already in debt, heavy debt, or very heavy loan commitments, please don't do premium financing. It's not probably not the best thing or wisest thing you can do lah. Okay, so that is that's what I can say. So if you talk about the risks of premium financing, there are actually quite a few. Okay, okay, so one of the risks I think is that people, okay, I'll talk about this with a case study lah. I have this client, okay, she's a DBS Treasures, and she actually has two premium finance annuities. Okay, the problem is what? The problem is that her total borrowings with the bank is 1 million. In other words, she loaned 1 million over two policies to buy two policies and for cash flow. And the big problem here is this. I asked her, do you know how the policy works? She's like, that time they explained to me, I remember, but now not quite. I know I borrow money and after I get some cash flow, and the cash flow I pay the interest and then I keep the rest. And I was like, yeah, but do you know what can go wrong? And she's like, no. And guess what? This was before they raised interest rates. So after they started raising interest rates, she was hit quite badly to the extent where the payoff on the policy is barely enough to cover the interest payments back to the bank. So basically, she put this money out, she's not getting a return. And that's the kind of risk that in a typical sales pitch from a banker or even a financial advisor, but I've done leverage financing before, but only when the client is very clear of the whole situation. So in the case of this client, or rather in the banks in general, let's just say that you may be exposed to a more optimistic story than it should be. Okay, well, I don't blame the bank. If they painted a pessimistic story, they would definitely not be able to get you to take out a leverage policy. So please be very, very careful with that. Okay, that's what I can say about the risk level involved. Okay, specifically four types of risk, but I will go into that later. Okay, so what kind of policies would be popular on financing? Okay, there are two in general. The first is legacy universal life. Okay. This is an actual advertisement. I think the policy is no longer around. Okay, but let me just explain the scenario to you. Okay, you are someone with 2 million cash on hand. You want to leave this money for a kid so that at least they have a, as always, they say, head start. Okay, or everyone else. But you also want to enjoy retirement. How? Got 2 million, either you leave or you enjoy retirement, but you enjoy retirement, nothing left for the kid. How do you balance these two out, right? Okay, so this is before financing steps in now. So if you have a premium of $1 million, okay, you get yourself a legacy policy that pays 2.9 million when you die. Okay, so what happens now? Immediately, your portfolio value goes from 2 million to 3.9 million. Why? Because when you die, there's 2.9 million. That one is guaranteed by a legacy policy, and you only pay 1 million for the premiums, so you got 1 million left over for retirement. In total, that is 3.9 million. So this is how you create an estate. Okay, And in fact, in the case of this example, actually, you wanted to leave 2 million behind, but you end up leaving 2.9 million behind. So actually, you increase what you wanted to leave behind, and yet still kept behind 1 million for yourself. This is your traditional legacy policy. Now, when it comes to financing, so original scenario, 2 million, you live with your kids, that's it. Okay, then you got nothing for retirement. Very sad. Not how retirement should be like. So now you use 1 million to get a policy, okay, which leaves behind 2.9 mil for your kid, okay. You still have 1 million for yourself. Okay, so I think this part is clear. But then here's the next thing. Okay, where does the financing come in? Okay, so the financing comes in, okay, if you borrow money against the policy. So I'll illustrate that. Okay, so now we look at the numbers. So as I mentioned in this example, this business person or whoever it is, now instead of having nothing for retirement, has 1 million for himself, 2.9 million if he dies, estate, his kid basically, assuming one kid, will get 2.9 times of initial premium. So you always get more than what you put in. If not, no point. Is that a scenario where policy could pay less than what you put in? Yes, I've seen that happen, but very rare. In that case, usually I do not recommend it. Anyway, I wouldn't do it if the policy pays out less than what you put in. Okay, so remember the premium is 1 million for the legacy policy. The question now I ask is, can you pay 1 million or can you pay lesser? So it is possible to pay less than 1 million, or at least in the traditional sense, you pay less than 1 million because you can borrow 90% of the value of the policy. So it's very important to note, you put a 1 million policy, you get a 1 million policy, the normal value of the policy will be 80% on the first day and increasing after that. Okay, so what most banks will allow you to do is borrow 90% of the 80%. So 80% of 1 million is 800,000. 90% of 800,000 will be 720K. If the bank is willing to lend you 720K, okay, to buy this legacy policy. And what's the collateral? Just like when you buy a house, the collateral is your house when the bank lend you money. So if you borrow money to buy a policy, the policy itself becomes the collateral. Okay, which also means one thing: if he's not paying 1 million for policy anymore, he is now having 1.72 million for his retirement because he paid 720K lesser. That 720K came from the bank. So this is how you can go from leaving just money behind to leaving an insurance payout behind to leaving an insurance payout behind and not having to pay the entire premium of the policy because you leveraged. Okay, so this, I think you see where I'm trying to go at here is, this is a strategy that can be used to multiply the returns. Okay, just like they say, property works because you can leverage, right? If the property value goes up, you actually make more because you make proportionally more because of the leverage on a property. The same thing actually applies to a policy. Okay, so this is what I think people need to realize. Okay, so let's say the interest is 1.5% on this borrowing of 720,000. He would have paid. Okay, so in the example, the guy was 50 years old, okay, but let's say he pays 35 years of interest, that's 378,000. He paid 280K at the start for the policy. He paid this, okay, so you have paid a grand total of 658K. Okay, the payout from the policy 2.9 million minus away the borrowing from the bank. And remember this, because the policy is collateral, the owner of the policy is the bank. There's nothing wrong with that. It's just that you need to be aware in terms of the legal implications. So after that, the policy, netting off the money owed the bank, you will actually end up with 2.18 million for your estate. Okay, but take note, you may leave behind lesser than 2.9 million if you didn't leverage that. Okay, but the trade-off is what? The trade-off, you end up, instead of 1 million for retirement, this person end up with 1.72 million for retirement. So I will say he is still ahead. Okay, he is still ahead. Okay, so there comes a point, of course, where interest rate, if it rises beyond certain levels, then the payout may not make a lot of sense. But generally speaking, I found that if interest rates are at 2 and below, okay, leverage can make sense. But then again, if it can make sense doesn't mean it is for you. You just need to understand that thing. Not everyone is suited for leverage policies. All right. Okay, so let's take a look at the numbers. Okay. So if you do nothing, that's how it looks like. Nothing for retirement, 2 million for your son. That's it. You buy without leverage, okay, 2.9 million for your son, 1 million for yourself. You do a premium financing, you have more for retirement. Your son still gets about 2 million. So not too bad. Okay. And the leverage is 3.3 times. So you see, leverage does improve your returns. But remember, you freed up 720K because you borrowed that from the bank instead of using your own money. This 720K, surely, you would want to do something with it. You can do things to generate a return on the 720K. Okay. And that would be things like a high yield saving account, decent FD, or even a cash flow annuity. Okay. And this is what you are supposed to do when you free up the money. Okay. When you have to pay $720,000 lesser and have that $720,000 more for yourself. The whole idea is that you take that 720,000 to do something so that you can finance the policy. Okay, question. Okay, all these still subject to underwriting. People with underlying users may not be able to buy or be loaded. Joyce, correct. If you are buying a legacy policy, there will be underwriting involved. Although, because it's a legacy policy, if you are generally healthy, okay, so most of the time there's standard. Okay, this is getting to underwriting, but let me just briefly share about it. There's standard underwriting, meaning if you are, you're a little bit of high cholesterol, a little bit of high blood pressure. I'm not going to say for sure, but generally you can still get a policy at that. But then you're very healthy, you reach age 50, no high blood pressure, no cholesterol, nothing. You may even get what we call preferred underwriting, whereby your premium actually is lower. And I've even seen preferred plus. Hey, this is where you are so healthy that your health is as good as a 30-year-old athlete or something, even at the age of 50. Your premium can come down so low that, well, not say very low, but definitely a discount over standard. Okay, and this is where it might actually be a good thing to have. Okay, but Joyce, that is on whole life. We actually haven't explored the other popular option for premium financing, which is actually cash flow annuity. That one don't need underwriting. Okay, so Joyce, if let's say for some reason a person is completely unable to pass underwriting, you still can generate cash flow with leverage annuity. And actually that's actually more popular in recent years. For the simple reason that you get to see the cash flow. Right? Instead of having to pay the interest payments on a whole life policy, but not really see any benefit from the policy. The benefit of the policy is not to you, is to your son. So most people, I think, will prefer a benefit of a policy coming to them. Okay. And then maybe something for their children when they're gone. Okay. But more importantly is they need to see the benefit, then they might be more keen on it. Okay. So just take note, this kind of loans, the interest has to be paid in perpetuity. So generally, either you make provisions for that, or let's say you retired. Okay, this is not about. I'm not going to give a parenting lesson here, but I did hear of this case where businessman took up a leverage universal life, which already paid a lot when he died, but then he retired and he said, "Son, this policy pays you 5 million when I die. Okay, but you want it, you need to finance the interest on it. You don't, you lapse, and there will be nothing left for you." So the son no choice but to pay the interest for the debt. Fortunately, not really a lot lah. The son can sustain it lah. But you see, sometimes uh money can be a motivator lah. Let's just put it this way. Okay. But in reality, you don't do anything like that, and you just want that leverage policy to benefit you instead of benefiting next generation, or more benefit to you compared to say a normal whole life, then cash flow is the king. Okay, so cash flow products can be also a leverage, can also be leverage. Okay, so basically same as a whole life policy, but in this time round, you will see cash flow being generated. Okay, and in this case, there's no risk in the sense that after a very short waiting period, depending on the policy, some as short as 1 year, okay, the policy will just pay you for the rest of your life. Okay, and then when you're gone, the policy will just give money to your children. Okay, so okay, this is all this policy is gone anyway, so I think no harm. Okay, someone takes a policy, cash flow policy. Strictly speaking, I would call it annuity if I could, but it's not really quite an annuity. Okay, anyway, okay. Someone takes our policy, 2 million. Okay. A short waiting now, 2 years later, you can get a cash payout of 6,000 a month for the rest of your life. Okay. But here's the thing. When this person passes away, this is the amount that goes to their estate, their next of kin. So you realize one thing, okay, this 2 million not only benefited Mr. Tan in this example, he also benefited his next generation. Okay, I think this is getting more popular because unless you really don't mind not seeing any benefits, most people will want to see some kind of benefit from their the money that they invested into a policy like this. All right. So cash flow, I always say this, cash is king, or rather cash flow is king. So basically what you want to do with the money is up to you. 6,000 a month. That's actually quite reasonable for a lot of people to do a lot of things if they want to, right? And one thing I want to tell you, even though this policy is off market, I know they pay 6,000 a month because I have clients with this policy, and of course not 2 million, but the policy paid exactly what was projected. Yes, it's a projection, but if it becomes reality, then you're just going to get it, and nothing wrong with that, right? Okay. So now, if you're Mr. Tan, but you don't want to put all your 2 million in, okay, then what you can do is premium financing, okay, on this kind of policies. So in which case, remember, you don't want to deploy the full 2 million. You want to deploy, let's just say the minimum possible. So going by this, 50% of 2 million is 1.6 million. That is the surrender value of a day one single premium annuity. Sorry, the day one surrender value of a single premium annuity. Sorry, jump it. Okay, so what would the bank lend him? 90% of 1.6 million, which works out to 1.44 million. Assuming he borrows at around 1.3, which was the rate that was around, it was around this rate when that policy was out there, okay? His interest expense a month will be $1,500, okay? But once the payout starts, 6,000 in, money of interest, he gets to keep $4,520 a month, okay? So if we do the maths, okay, if he didn't finance, he doesn't have to pay interest, he gets 72,000 a year from the policy, and basically 72,000 divided by 2 million gives a yield of 3.6%. If he finances, he pays 560,000, which is about 72%. Okay, he has interest payments every year. Okay, but after deducting the payout for him, his net that he keeps would be this 54,000. Okay, and okay, I don't think I did the math wrong. Now I'll check the math during the break. But basically, he will actually have a yield of 9% because his net interest payout divided by what he put in. Okay, I think I might have made a mistake, but let me confirm that. Is actually higher. So basically, financing increases the yield. Okay, how will the yield drop? The yield will drop only if the interest goes up, which admittedly the interest has gone up and then come down again over the past 3 years or so. But you get past that waiting period, then of course your yield will improve again. So people with finance policies, good and bad, but if financing is beginning to bug you, then of course you may want to reduce your exposure. Okay. So yeah, that's what I can say. Okay, sorry, this should be 18,720. I bet. Okay, but you can see that he gets 72K a year, he net off 18K of interest, he will keep 54K for himself. Divided by the 560K, okay, yeah, then the 9% is correct. The 9% is his yield. Okay. So he's basically leveraged, but with a reasonable yield of 9%. So if he can do that, what this means is that he frees up additional 1.4 mil. Okay. And why is it not quite 1 point? Okay, why is this figure so strange? Is because I believe I also included the money that he needs to cater for the first 2 years of interest that he has to pay before he starts to receive the payout. Okay. So these are the 4 risks of financing that I was going to talk about. Okay, so first is liquidity risk. Okay. If the policy doesn't have a guaranteed surrender value, then you are very likely, if the policy value drops, okay, for whatever reason, then it's like a margin call when it comes to stocks. You may be forced to liquidate your policy. Okay. So that is the thing to note. You may be forced to liquidate your policy, or uh, that would definitely result in a loss, because you liquidate your policy, your surrender value is lower than what the total premium is. You are definitely going to have to pay back the loan from the bank, and then we come out of it all, you are negative. Okay, so liquidity risk small, but I think it's worth noting. Second risk is interest rate risk. Okay, this one is the more common risk that people will see. Okay, that means this kind of finance policies, if you are actually financing it, is typically a 1 or 3 month revolving loan. So every month or every 3 months, the bank will tell you, okay, your loan interest for the next 1 month or next 3 months is how much. So this part, as we all know, in the past few years, has been affected by interest rate hikes. So you may be forced in the situation where the interest rate is so high that you actually cannot see the benefit of the plan. That means your 9% yield drops to 7, drop to 6, drop to 5. You can even drop to 4%. Then it starts to feel a little bit stretched. Okay. Okay. And especially the financing rate, the interest rate charged by the bank is higher than investment return. So this is the more prominent risk, interest rate risk, but it can be managed. Okay. Next is renewal risk. The bank that lend you the money actually has full rights, okay, to not renew your loan. Okay, so I remember I said the loan is 1 month or 3 months typically. Okay, so these 1 month and 3 month loans, okay, they renew every time, but for whatever reason, the bank says that okay, I don't think I want to renew you anymore. If that happens, you have to repay the entire loan on the spot. Okay, if not, they will liquidate your policy and take back their money, and this will also result in very big loss. Again, this renewal risk is not something that happens very often, but it is a risk that everyone needs to be aware of. And then the last risk is crediting risk. Now, we know that numbers are projected, okay, and therefore, let's say even the $6,080 projected example just now, okay, is not guaranteed. And yeah, it can't be lah. If it's guaranteed, it's too good to be true. That will be like 3.6% return guaranteed. Okay, but okay, most of the time, as I always said, many times over, if the insurer can credit at maximum returns, there's no reason for them not to, because it buys goodwill, it makes sure that you remember them when you're looking for something new. Okay, or you may even want to recommend them to your friends if you had a pleasant experience. For example, if you went to a good restaurant, you had a good experience, I'm sure you will tell your friends, hey, this restaurant was not bad. Okay, having said that, we know that there are instances where, for example, things like a global financial crisis could cause the crediting rate to be not credited for that 1 year or so. Okay, but usually after that they resume it. So just be very aware of this. Crediting rates are not guaranteed. Most of the time, I'd say 90-95% of the time, they should be given. Okay, again, not guaranteed, but they should be given. Okay, and the amount of crediting will affect how much are we charged, meaning that 9% you that you get. Okay, Tan asks, can we redeem the loan early if interest turn again us? Interesting, you should talk about that. Short answer is yes. Long answer is this is part of risk management when you take a premium finance loan. Okay, let me explain. Okay, so okay, I know it's a wall of text. Let me just highlight the key things. Okay, basically premium financing is debt. Okay, originally you do finance is zero risk. You finance, you have the risk of interest rate crediting, all of that. Okay, but okay, because of the interest of the additional risk that you take on, remember the yield jump from 3% to 9% in the table I showed just now. The whole point of taking on that risk is to increase the yield that you're getting from a pretty vanilla policy like that. Okay, so Tan asks, can we redeem a loan early if the interest rate rise? Answer is yes. At the next loan renewal, you have the option 2. You do not have to redeem the loan. You could even just pay a bit of it so that you bring down your total interest payments. But most banks will have a clause whereby you need to give them advance notice. Okay, so just think note of that. Okay. Okay, a few things I already mentioned. Surrender will leave you with less money than what you started. And of course, interest rate go too high, you might face an issue financing a policy. Okay, so just make sure, especially before the policy start paying, make sure you plan ahead for those 1 to 3 years that you won't see a payout yet. I think that's very important. Okay. So now Tan asked about renewing a loan. I'll talk about risk management policy. A few things you can do. Borrow less. Now banks are willing to lend you 90% of 80%, okay, of the premium. Okay, remember 80% is because the first day value of a policy is always 80%. Bank want to lend you 90% maximum. This works out to be 72% of your premium. But the question is this: can you borrow lesser? Answer is yes. Okay, you don't have to borrow maximum. You don't have to borrow 72%. No one say you must. You can borrow 50 and put 50 yourself. Nothing wrong with that. That does, of course, reduce the yield you get, but it will also reduce your risk level by a bit. And if you're more comfortable with that, go ahead. I once had a policy whereby the client actually borrowed 2/3 and put up 1/3. And the bank was so confused because they never seen anyone do it this way that they called me, the insurer BDN called me and said, hey, is the number correct? I'm like, yeah. I sat down with the client and did the calculations, and we did not want to go maximum loan. It is 2/3, 1/3. Please proceed. Yeah. So it is very possible to arrange a 2/3, 1/3 arrangement, a 50-50 arrangement if you want to. Okay. So this, of course, reduce your chance of getting hit by the interest rate and things like that. Okay. So, and of course, remember, a higher base guarantee payout does give you some form of cushion, because if market turns bad, you know that the guarantee payout is guaranteed by contract, you get paid out. Okay, so a higher base guarantee payout ensures that you have a certain minimum coming in, and that minimum can help you to pay your interest. Last thing, find a policy that pays quicker. I think this one is no-brainer. Okay, so your policy that pays out after 1 year, I think that's pretty good. Okay, because you would be able to just you just need to get past 1 year of interest payments, and then the cash flow comes in. You can start to see that positive arbitrage from the policy. Okay. So leverage is not just for high net worth individuals. I know the examples have been 1 million, 2 million, that kind of thing. But leverage can be done with lesser than that. Okay. So I think what I want to say is that leverage annuity is practically like how you buy a property. Most people buy a property by putting a down payment. Assuming it's an investment property, you put a down payment. So that's like your premium. You borrow money for your from the bank to pay the rest of mortgage. So that's like the premium financing. You find a tenant, the tenant moves in and pay you rental income. And it might take a while to find a tenant, or the property may need like 1 more year to be built or 3 more years to be built. Then the tenant move in, you get a rental income. That's like how a leverage annuity just needs you to wait 1 to 3 years before you get a payout. So there's actually a lot of parallels between investment property and leverage annuity. A lot of parallels. But in fact, to some extent, there's something I call leverage annuity, the equivalent of a virtual property, a property that you cannot see, you cannot touch, but functions just like that by paying you rental income. Okay. But one thing to note, investment property requires you to down eventually pay off the mortgage. A leverage annuity, you may just choose to pay only the interest and never pay back the loan in perpetuity. And that means that the amount you get, the net you get from that will be higher. Anyway, I think one advantage of a leverage annuity is the income is non-taxable. Okay, you don't have to worry about maintenance, hidden costs. You don't need about worry about your tenant destroying your living room for whatever reason. Okay, now that's going to happen. Okay, not with a leverage annuity. Okay, so that's really passive, because I understand that, or at least from the discussions I've had with my clients, uh, tenant management, if it gets out of hand, it can be really, really messy, because I think some tenants really can cause a lot of trouble for people. That's what I can say. So you do premium financing properly, you just need to make sure a couple of things. First thing, you must have the exit plan. Okay, actually, I talked about case study 3 already. That was the 1 million loan I mentioned earlier. But I have 2 more case studies. Sorry, it should be E here. Okay. Actually, case study 2 also lah. Yeah, that was the 2/3, 1/3. My client with 2/3, 1/3. He wanted to do a leverage annuity. In fact, he was going to borrow maximum. I told him, no, I'm not letting you do that. Okay, why? Because it was the right thing to do lah. I know his situation. I did not feel comfortable with him borrowing 7 figures from the bank. I make him scale now his policy to 6 figures and then borrow what was more practical. Okay, but case study 1 is something that I have not shared yet, and I think I will talk about it a bit. Okay, so I have this client, the leverage annuity. Okay, he was exploring this annuity. Okay, and I know this annuity is not bad. Okay, so what happened is this: the annuity requires a minimum single premium of 100,000. Okay, 100,000. I mean, not say a lot, but also sometimes if you are raising kids and all that, you may not want to like completely put aside 100,000 all at once and be left with very little liquid cash lah, right? Okay, so what did we do for him? Okay, he put 28K up so that he can start the policy first. And we borrowed 72K, not from a bank, but internally. Okay. For those who didn't know, we also have Philips also have money lending division, but I won't talk about that too much here. Okay. So he put 28K up for 1 year. Okay. Sorry, it was a 2-year waiting period. Sorry. 2 years, he put out 28K first. We borrowed 72K. He paid interest on the 72K for 2 years. And then guess what? Within that 2 years, this policy was so popular, it reached capacity, insurer took it off market. So at the end of 2 years, if he had waited to save up the money to buy a policy, he would not be happy able to get the policy already because it's off market. But by getting it via the leverage route, by putting in kind of like a 28K, you want to say this is an option payment or like OTP for house or down payment, whatever, it's functionally the same. By starting with a 28K down payment, okay, and borrowing the 72K, he got his foot in the door before they took the annuity off market. After 2 years, he saved us some money. The loan was up for renewal, 72K. We repaid a portion of it. So now his loan dropped to 50K. And then we renew it for 2 years. Okay. So I think you see where this is going. It has now been 4 years already. His next renewal is up and he's deciding to fully pay off the last 50,000 so that the policy is fully paid by him. I mean, this regarding the interest that he had to pay for the first 4 years, but remember, it's only 4 years. The policy actually started paying him at the start of year 3. So what he did is basically he repaid the policy in full, and I'm glad to say that as of I saw the letter come in my inbox. As of I don't know which day in November, earlier this month. Okay, the policy, the full 100,000 policy is now in his name, and he can now fully enjoy the policy. So basically, leverage was used to help him get his foot in the door, so that if the policy disappears, he already has it, and then he slowly work towards paying off. Okay, so you think of it as this way: is yes, no doubt the policy is only single premium, but by doing it as leverage, he first paid 28K, then 2 years later he paid 22K, and then another 2 years later, which is this year, he paid off the last 50K. So we have transformed a single premium policy, a strictly single premium policy, into a regular premium policy where his payments are split over 5 years in a timeline that he's comfortable with. And after that, done. Policy is his, he take back control. Okay. So this is how leveraging premium financing can actually be used to kind of like I don't say manipulate, but kind of like make things work towards your advantage. Okay. Now, Tanas can need to consider TDSR. So this is where it gets interesting. You're going to borrow money from the bank, you need to consider TDSR. Banks will consider will look at that. You're going to borrow money from a licensed money lender or from okay, not say a licensed money lender. Okay, in this case, of course, like I mentioned, Philip, we have a money lending arm lah. Okay, because we are a licensed money lender, we are regulated not by Ministry of Finance, we're regulated by Ministry of Law. Okay, of course, I can't share too much more other than if you want to know more, you have to in black and white make an inquiry with me. Okay, but basically, there is no TTSR in consideration. Okay, there is no. So, Tan, to answer you in short, if you go by the correct method, even if your TTSR is maxed out because of your mortgage, this kind of financing done through the right channel, don't have to consider TTSR. I hope that answers your question. Okay, so premium financing, very interesting use cases. I think my case study one is actually probably quite pleased with the fact that it is really a good policy. It's just, if he waited too long policy on market, he will not have participated in it. But now he's got it. Yeah, no doubt he had to pay the interest charges, all that. But I think given that this kind of policies, you expect to hold them pretty much for the rest of your life. The the interest charges for the first 4 years of this policy for the loan is nothing compared to not being able to get your foot in the door, if you know what I mean. Okay. Then can the loan be refinanced to different bank? Okay, this one depends. This is not like mortgage lah. Usually, uh, you won't be able to refinance to different bank. If it's a bank loan for this kind of policies, usually not, but there can be exceptions. It depends on the policy, whether it is the insurer is insurer that the bank wants to work with. Okay, so I'm sure some of you know, UOB only do Prudential, DBS only do Manulife, OCBC only do Great Eastern, CIMB. Anyone know what CIMB does? Just as a pop quiz while I drink water. Anyone knows CIMB what which insurer? Anyone want to guess? Come on. Can't be me talking all the time. Interest at the mercy of the bank. At the mercy of the bank every month when they renew, but it generally follow the interest rate environment. So of course, actually this kind of premium financing interest was actually quite low until the Fed started hiking interest rate. So that's why we always say have an exit plan, make sure you plan properly. Fabian says AIA, good guess. No. CIB works with Singlife and NTUC Income or Income as you know it. What about RHB? Okay, now I'm not going to test you all. I don't expect any of you to know all the answers. But yeah, you can see that premium financing is interesting. Citibank was with AIA. Okay, Fabian, in case you're wondering. Yeah. Okay, so having said that, before I completely lose my voice, let's take a short break for 3 minutes. All right. And we'll come back at 9:10 and I'll carry on with a few more advanced strategies that yeah, and let's just say the last one should be quite mind-boggling. Okay, so we're coming at okay, it's 9:08 now. We're coming around 9:10. Quick toilet break for everyone, water break for me, and I will see you then. All right. Hi, all. Sorry, I need a bit more time because of my throat. Let's resume at 9:15. For those of you not here, I'm just going to leave a short message in the chat. Yeah, I just need a bit more time to clear off what's stuck in my throat. Sorry, everyone. We'll resume at 9:15. Có mò chí,打包。 Okay, we are back. All right, hope everyone had a good break. Sorry, I should just made it 9:15 for the start. Okay, let's resume. Where were we? Yeah, okay. So advanced estate and tax planning. Okay, I am not going to talk about setting up a trust or foundation or things like that. That is beyond today's scope, although suffice to say that that's definitely something that some of you may want to think about. Okay, but I will start with a very simple concept. Uh, Estate planning is something that I think everyone should do, and it's helpful, but you must have estate first, right? So you don't have estate, then there's nothing to plan for. Okay, but if you want to do the estate planning, then you need to ask yourself, what estate am I leaving behind? Okay, and then next question, you think you leave behind something for your next generation or loved ones or what, but then how can you guarantee it? Okay, so I think some of you are seeing where this goes, and how do you multiply what you leave behind? So if we look at the previous example of the legacy policies, instead of leaving 2 million behind for a son and nothing for retirement, the person in the example bought a policy, right, to multiply what he had, and then what you call that? He had more for his retirement, and yet he still created that 2.9 million estate for the son. Okay, so that is guaranteeing, and on top of that, multiplying. So remember the example, it was 2 million. Okay, he got not, oh, wait, let me write that again. 2 million, but by guarantee, he could leave it behind just and not use it for himself, but by putting 1 million in a policy, if we don't talk about leverage now, okay, not only did he guaranteed that when he died, the policy gives 2.9 mil, he actually multiply his money. Okay, so insurance as an estate multiplier has its role, okay. It's just that whether do we actually see it that way. Okay, so this can be a different perspective, I would say, because a lot of people may not really see insurance for the kind of tool that it can be used as, because maybe you have not been conditioned to see it this way. All right, so so you have things to dispute, like I said, you need estate planning, but some things are not easily disputed. So I have this example of this couple. Husband is 62 and the wife is, I think, 60. And they have two properties. One is their primary property, and the other is a property that they bought for investment purpose, and it's both are freehold, but one is well maintained and the other one is slightly run down. And I did ask them, so which property goes to which daughter? They have two daughters. And then they told me one property for one and a second property for the other. And then, so let's just say the good property, the one in better condition, both are roughly worth the same, but one is in better condition than the others. Okay, you leave it for daughter A, and the not so good property, you leave it to daughter B. Okay. So they told me this. I can't remember which one was A and B, but the idea is that. So I said, then do you think B will be happy to receive the not so good property? And they were silent for a while. So that just goes to show that some things like property, things like precious jewelry, very hard to cleanly split it amongst two children, especially if you don't have a favorite, you just want to be fair to both. It's very, very hard to cleanly split this kind of things behind. Okay, so estate creation, yeah, no doubt, let's say maybe you're a businessman, you have two sons, one doesn't want to be a business owner, and the other one wants to be a business owner, or is, has the caliber to take over your business. Then, of course, when you die, you pass your business to the other son, and the first son doesn't take over the business. But then the question you need to ask after that is, will the son that doesn't take over the business be happy with the way the estate was distributed? So estate creation is itself an entirely very big topic on how to equally split and all that. But the idea here is that in the example of two sons, if the business is valued at this much and the remainder of the assets is valued at this much, okay, the way to equalize it is to ensure that when the business owner dies, okay, this gap here that I draw with the arrow can be plugged by the payout for a policy, so that the business savvy son gets a business value at I don't know, 5 million, and the son that doesn't want to run the business but wants to do his own stuff still gets a 2 million asset that you have, and then the remaining 3 million is plugged by a payout. We call this gap insurance. okay, which I don't know how many of you have heard of it, but we call this gap insurance. Why? Because as the name suggests, by function, it plugs the gap in your estate distribution. Okay, gap insurance is probably one of the things that I see very commonly in when it comes to ensuring that there is something left behind that can be tangibly split without too much noise. Okay, because if one side is getting a 5 million business and the other side is getting 2 million asset, the one getting 2 million asset confirm not happy. Okay, so gap insurance is one of the things to plug this thing. I know it's not in the slides, but I just wanted to share it. Okay, so now next thing, how do you create this gap insurance? Okay, so let's just give a very simple scenario. Okay, and I'm trying to bring it down to a level where, we're not talking about business owners or SME owners with lots of money. We're talking about average person or who has worked for many years, 10, 15, 20 years, accumulated a nice amount of money and wants to make sure that the next generation can be provided for. Okay, so we got a 40-year-old male, and this person has earmarked 250K for his next generation, okay, to be distributed when he's no longer around. So what kind of options does this person have? We already know one, do nothing. Leave the money there. When he dies, it's in the bank. They're going to split the money. We also know option two, and I think you all know what I'm looking at here. Option two is to get something that multiplies money, aka that gap insurance I'm talking about. But okay, the gap insurance can exist in many forms. It could be universal life and things like that. The issue is that for a lot of people, okay, maybe not too many people nowadays, but it used to be universal life policies. We are talking about premiums in 7 figures, which is not something that everyone can swallow, and I can completely understand that. What if, however, you could have this kind of gap insurance done in a way such that your premiums are somewhat manageable and you actually pay finish over, say, your working lifetime, because maybe you really don't have that 1 million to just put down for that kind of gap insurance. And the answer is yes, it can be done this way. It's just that whether do we think about it this way. So this is an example of gap insurance. Okay, this person wants to make sure he leaves 1 million behind for his next generation. For 24 years, which basically takes him up to the age of 65, 10,000 a year means that this would come out to a total of about 250K. Okay, it's the same 250K he intended to leave behind, but because he used gap insurance to transform that 250K into 1 mil. And I know what some of you are thinking, what he leaves past 58 years. In other words, he leaves past 99. Okay. All we need to do is find the right gap insurance that will ensure that should he leave past 99, the longevity payout, or rather the so-called congratulations payout, you want to put it that way, the payout from the insurer will be 1 million. So in other words, he died before 99, 1 million. He lived past 99, also 1 million. In other words, he lived past 99, the policy end, they assume he died and that's paid the 1 million. So in other words, the 1 million is guaranteed. 100% guaranteed. So this kind of gap insurance is something that I don't know how many of you have thought about, but it's something that, especially if you, let's say you have 2 children and maybe one child isn't getting married, so you want to give him more resources to help him out because he's by himself, and your other kid is married, so you want to give, but you don't want to give as much. By simple method of a nomination, okay, you can actually ensure that, let's say you want to give 60% to the child who isn't married and 40% to the child who is married. Okay. And you communicated this to both your children and they're okay with that. And the one who's married understand that his other sibling may need more financial help. This gap insurance completely solved the problem. Okay. It's very clear cut. Okay. And because we structure it in such a way that first thing, the 1 million is always paid out. Second thing, you never pay forever. As long as you reach age 65, you pay finish, you're done. The policy cannot lapse. There's a few more things I can say. This gap insurance also has a cash value you need to surrender. But ultimately, this is how you plug the gap. And if you're wondering, does it make sense to put 250K to get 1 million, even if you die at 99? I've run the numbers. You die at 70, you pay 240K. Okay, let's take it as 250. This is a guaranteed rate of return of 7%. There is no instrument out there with a guaranteed rate of return of 7%. In fact, you pay 10,000 and die tomorrow, the rate of return, I think, is how many million of percent. Okay. But let's just assume you pass away at 70 after paying everything, this person. That's a 7.6% guaranteed rate of return. How many instruments out there got 7.6% guaranteed rate of return? Even if you die at 80 is 5. Even if you die at 85 years old, is a guaranteed 4.2% rate of return. That means you put 240K, we factor time value of money, and then the 1 million payout comes when you die at 85. 4.29% guaranteed return. No instrument on the market can do this. Okay, but of course, we hope no one dies prematurely. Okay, but let's say you really reach the age of 99, you outlive 99, you get a 1 million payout, it's still a guaranteed 3.02%. Where are you going to find a guaranteed 3.2% instrument? From age 40 all the way to 99. And this is a 40-year-old male. If you're a female, it's even cheaper. The premium is even cheaper, meaning the rate of return is even higher. So term to 99 as a form of plugging that kind of gap insurance is something that I think if your circumstances dictate it, I think it's actually something very interesting worth considering. Okay. So, and on top of that, okay, we need to consider a few scenarios. First thing is if you die without a will, okay, you die without a will, okay, you need to go to the courts to file for letters of administration. Okay. After you file and provide everything, typically you need to wait around 3 months or more, from my understanding of what my lawyer clients tell me, 3 months or more before you are allowed to disperse the estate monies. Okay. You die with a will, you go and get your grant of probate. But same thing after filing, you typically even need to wait around 3 months to have access to all the assets that you wanted to distribute. But you make the payout via a nomination. Sometimes the funeral haven't over. If it's a very long funeral or grand funeral, within 14 working days, if everything is in place, the payout will come. In other words, an insurance payout is probably one of the fastest ways to distribute your estate. And the best part, you have will, no will, doesn't matter. As long as you made the nomination and it's proper, and you provided all the documents when the person passed away, and no foul play suspected, all that, of course, then your payout of 1 million will just come within 14 working days. This is faster than anything I know. Okay. So granted, what term to 99 is not really for everyone, but to the 40 of you here, I'll just say one thing. You haven't made your insurance nomination, please go and do so because it makes the distribution process so much easier for your loved ones. All right. So that's just one message that I think you can take back up from here. Okay, so that's term to 99, that's gap insurance. Next, insurance splitting. Normally, one policy is only for one person. I think we all agree on that. But is it possible to have a policy on one person and then you wish to pass the policy on to the next generation, but then you have two people in the next generation and they themselves may have their own children and so on and so forth? How do you split the policy? So in this case, you need to get a policy that can split, as the name would suggest. And surprisingly, yes, there are policies that can be split in this manner. Okay, so this one is rather new concept. Okay, it's not been around for very long. So all I can tell you is I'll use case studies to illustrate from the products brochure. Okay, so text may be a bit small, but let me just run through you. Okay, so we got businessman age 50. Okay, one son, and then he wants to prepare for his wealth to kind of like distribute down to others lah. So he wants to prepare 2 million. Okay, and then he decides to just pay 1 million because he knows that of the leverage power insurance, he pays 1 million, his next generation will get more than 1 million. Okay, so what happens now is this. Okay, the businessman Michael puts his son as the insured, and then after some time, he decides to change the policy owner to his son. Let's say the son now becomes 21, able to hold a policy. But at the same time, the son also says, okay, wait, now I have a what you call it? I have a son myself. Okay, so this Jacob here is the grandson of the first person, and thanks to the fact that policy can be split, the second generation chooses to hold on to 40% of the value of the policy, but the third generation now benefits from 60%. Okay, so you see this split. And without going too much into the details, I will say that you can further split. And okay, let's just say this. Okay, how many of you think, okay, what's the longest you think an insurance policy can last? Anyone want to guess? How many years can insurance policy last? We heard of term to 99. Okay, just now I share endowment of 125 years. How long do you think a policy can last maximum, theoretically? Anyone? 3 generations. Good guess. Anyone else? Life in being plus 21 years. Also good guess. Okay, most of the time, 3 generation actually depends on the middle generation. So 3 generation plans means that you okay, the grandfather buy for the son, and then that buys on the son life. But when the grandfather dies, because the son is still alive, policy still continue. When the son dies, the payout goes to the grandson. Okay, so this is your typical 3 generation policy. Generation one, and then generation two, which is the son. Generation three, which is the grandson. In which case, actually, I would say this policy only lasts for the lifetime of the son. Now, for a splitting policy, and also the only splitting policy I know on the market, this policy will last 300 years. 300 years, you didn't hear that wrongly, which means that it potentially can benefit more than just 3 generations. It will probably benefit far more than 3 generations. If you assume one generation is about 30 to 40 years, a 300-year policy can benefit somewhere between 6 to 8 generations. Okay, so this is something unique that I don't know how many of you have heard of it. I don't think there's a lot of you have heard of it, but you can see that there is a use case, like, especially if you want to keep wealth within the family. And there's a Chinese saying that wealth doesn't go past 3 generations. Well, if you lock up the wealth nicely, then of course you can always ensure that as long as there's some policy owner that is still alive, okay, the policy carries on and on and on and on. Okay. Now, of course, I will say one thing. By year policy 100, are these numbers realistic? Honestly, I don't know. Okay. But even if they're not realistic, we all can agree on one thing. The policy won't be a million already. Definitely the value will be more. It's just that whether it's really 96 million or not, no one really knows. And anyway, if you're doing this for your next generation, by the time the policy is 100 years in existence, you're likely gone already. Okay, to be frank. Okay, so splitting policies is relatively new thing. I just thought it'd be interesting to share this because I don't think many people have heard of it. And yeah, because this policy only 100 years, there's still another 300 years, there's still another 200 years left for the policy to continue going. And the hope of these policies is that they accumulate value that you need. You can draw, you can take a loan. Okay, as long you can take a loan and choose to repay it later on. You can take a loan and if the policy is split, when you're gone, you can choose to have the loan cancelled off by your fractional portion of the policy when you are gone. Okay, and there's a lot of flexibility in it. Okay, so want to split how many levels? I also have no clue. I believe this one really can be structured to split into a lot of sub policies, but ultimately, I think the splitting thing is what really makes it so unique. Okay. We've got another example, but I think it won't. Okay, so we can see that yeah I know numbers are relatively huge, but this basically means that okay, you have the option to set things up for your second, third, fourth, fifth, sixth, even seventh generation nicely. Okay, but of course, I would say that some people say, what, my next generation misuse the money. This one I can't do anything about that. It's about values that you impart to your next generation. But okay, if you provide the funding and you provide the right values, then I would say the next generation will just go forth and multiply the money. Okay, so this is splittable policy lah. Okay, splittable policy. Any questions about splittable policies? I think I have to take that offline because honestly, this is, like I said, a relatively new addition to the insurance space in recent years, and not for everyone lah. Okay, not for everyone. Okay, so any questions so far other than for splittable policies? Anyone? Well, I drink some tea. No. Okay, we come to the last thing, which I think may okay, I hope it doesn't give you a headache. Okay, now no talk about PPLI. How many of you have heard of PPLI before this? If yes, say yes. If no, can say no also lah. It's okay not to have heard of PPLI. Anyone heard of PPLI before this? No. No. Okay, I'm guessing no lah for most people. Thanks, CH. Everyone? No. Everyone? Okay. Can. No problem. No problem. Okay. PPLI is a very interactive portion. I'm going to ask questions and I hope you all can participate. All right. Okay. So what's PPLI? I'll answer that later. Okay. But first and foremost, let me ask a very simple question. What is a premium? We all know what's the insurance policy, but what is a premium? Okay. Anyone want to try answering this question? Let's type out a simple, let's type out something in the chat box. Okay. I'll wait a minute or two. What is a premium? Anyone want to try? Come on. Hmm. Content or coverage of the policy. Okay, that's a nice answer. Not bad. That's actually more of the schedule of the policy. Okay, Yong says what you paid. Okay, close. Yeah, in a way is what you pay, but of course, pay most people think of cash, right? Okay. Mark says payment to be insured. Okay, yeah. So most of you are talking about payment in the form of like money that okay. So Fabian says a subscription fee. Okay, yeah. So you have the idea that it's basically something that you present to the insurer. In exchange, you get the protection. I think we can all agree on that. Okay. So the next question, okay, Ray asked, not sure if you heard about foundation policy launched by Income in 991. Yes, I heard about that for that policy. Foundation policy is an endowment. But you have a question about that, we take that offline, Ray. Okay. Okay, the next question I'm gonna ask, okay, after what's the premium is, which of the following can be accepted as a premium? I'd like you all to give me your answers in the chat. These are all three questions. Which of the following can be accepted by Ray says all above. Interesting. Okay. Anyone else want to say all? All the above. Why everyone say all? You all know what's coming up. Sometimes when I ask this question, people say cash. Okay. So, okay, I think all you are saying all. Good. The answer is all. Okay. Yes, most people pay cash to pay the insurance premium. But who says, okay, by the way, when I say unit trust, for example, I'm not saying you liquidate the unit trust and then use it to pay for the premium. I'm saying you pay in the form of a unit trust. When I say stocks and shares, I'm saying you pay the premium in the form of stocks and share. When I say gold bar, precious metal, office building, even land, okay, you're actually paying insurance in that form, not selling it off to raise the money. Okay, and no, Joyce, not using collateral. Literally, we are talking about the insurance company say that I accept this. Let's say you own this freehold commercial building, and you say to the insurer, I'm going to pay you with this commercial building by way of transfer of ownership. Will you accept it as a premium? The answer is actually yes, provided you are dealing with the right insurer and the right setup. You can pay for an insurance premium with anything as long as the insurer accepts. How many of you have heard of this before? Anyone? This usually cost of. Okay, so Fabian, yes, in a way, you are right. There is a consideration. The question is, will the insurer accept the consideration? Okay, so for most people, most policies, cash pay now, gyro bill payment, right? So I don't think many of you will have realized that if you actually own an office building, you can actually use that as premium for an insurance policy. So the answer is all the above. You can pay for insurance policy as long with any of these, and even, well, it's not just this. The list is not exhaustive, but you can actually pay for insurance premium with anything that of value as long as the insurer accepts. And why this is important, okay? We will get to that. So, okay, now before we get to that, now let's ask the next part. You buy insurance policy, something happened, there's a payout. Okay. What do you all think is a normal payout from the insurer? Cash? Do you all agree cash? Anything else? Anyone? Anyone has any suggestions for what kind of payout can the insurer give you? Anyone at all? Okay. By the way, the definition on the screen is just your typical definition of a payout or benefit. Basically, what the insurer pays you in the event that the loss is the event is triggered and they have to get the payout. So I'm not sure how many of you know where this is going, but basically, these four and more actually can be considered valid payout. Payout of insurance does not have to be in cash. It can be in the form of a car, a condo, stock holdings, precious metal, jewelry, gold bar, anything of value. Okay. So how many of you find this new to you? That you can pay for insurance with a GOBA, and when you die, that GOBA is the payout to your next of kin. How many of you find this concept new? So I'm just trying to see how many of you and you heard of this before? Really? No, no, no one want to answer. Okay, so anyway, yeah, new to you. Okay, thanks, Eng Chong. Yes, some of you is new. Okay, so this is a race is car depreciation. Okay, we are not talking about your usual Toyota or what. We're talking about those kind of probably cars that can retain value over time. Okay, Mark says never heard of it. Yeah, most people will not have heard of this. That's why this is called advanced insurance technique. Okay, so what have we established so far? You can pay for insurance premium with a GOBA and get the payout in the form of a GOBA. You transfer a GOBA and an office building into the insurance policy, you can have the insurance policy set up such that whoever you want the to inherit the office building goes to the person in the form of the office building, and whoever you want to inherit the GOBA, when you die, the GOBA goes in the form of a GOBA to the person. It is actually allowed, and this is why this kind of policy is so powerful. Okay, precisely by this nature. Okay. Third thing I'm going to ask: are insurance payout tax free? I think most of you should know the answer. So is it tax free? Yes or no? Very simple. Yes or no? Anyone want to just answer this? Yes, excellent. Yes, insurance payout is tax-free. So I don't know if you all can start to see where I'm coming at, but if the payout is tax-free and the payout can take any form, any tangible form, then do you not realize that this makes this type of PPI insurance a very, very unique tool for estate planning and tax planning? Okay, why? Okay. Okay, wait. Yeah, one more question. Are insurance policies protected from creditors? Yes or no? Anyone want to guess? No. Okay. Any other answers? Okay. Actually, if structured correctly, insurance policy can be protected from creditors, but only this at this level. Okay. So long story short, answer is actually yes, it can be. Okay, spouse insurance beneficiary. Okay, we are thinking traditionally. We need to think beyond normal insurance policies and look at this level, PPI, whereby okay, you can actually protect insurance policy from creditors. You can even set the value to zero, and then you can tell them the policy is worth nothing, even when the policy is wrapping around a GOBA, stocks and shares, and office building, for example. Okay, it is possible. It's just whether you have um, the right setup, I would say. Okay, so what's PPI really? At this point, I think I better start explaining what's PPI. PPI stands for Private Placement Life Insurance. This is a kind of insurance that, as the name suggests, is private, meaning you're not going to find it off the shelf. It is very, very customized, okay, to the specific person looking for it. So, for example, you're looking for a term plan. Let's say you're just looking for, okay, I'm just not talk about Singlife, okay. It's not endorsement, but let's say you're looking for a Singlife plan, a term plan. They have this plan called Singlife Elite Term. Okay, this is a term plan. This is off the shelf. It's just that you can configure it for how many years, for whatever age you're protecting for, how much you want to cover all that. Okay, PPI, private placement, is definitely customized. Okay, so in the case of a PPI, because it's so customized, it will require a lot of discussion, not even talk about underwriting, a lot of discussion just to set it up. I just want to let everyone know about this first. Once you set it up, once you have a PPI policy protecting everything you own, okay, any group inside is tax-free. So this is particular importance for people who are worried about taxation. Okay, for most of us who will probably live and retire in Singapore, that is probably not an issue unless they introduce inheritance and estate tax again in the future. But no one really knows, but they can't retroactively apply to a PPI policy. Okay, so your assets are already in a PPI. When if let's say Singapore reintroduce estate tax or what, they cannot apply it to your PPI because your PPI is set up before introduction of estate tax. However, okay, I have a client who is an Australian PR. She wants to retire in Australia, but Australia has a lot of taxation laws. A PPI, if we can find a way to make it work for her, will be one way to ensure that, because Australia law is such that if you grow your assets and even you retire, you're supposed to declare asset every year. then they will tax you on the growth difference. Okay, there are certain rules. I won't get into that. That's a tax advisor's job, but a PPI will negate that completely. Okay, Joyce has a comment. Must be a lot of service charges by insurance company for them to take care of assets for protection from tax and creditors. Naturally, you cannot expect this to be done for free, lah. But what I can say is this: compared to actually paying the tax and the creditors, the PPI is definitely the cheaper way out. Okay, that one I can almost certainly assure you that, Joyce. All right. Okay, because we're talking about taxation. Okay, what's the highest tax in the estate tax in the world? Anyone know? I recall it will be Japan at 55%. Okay, PPI will completely negate this. Other countries, as US 40%, PPI will completely negate this. Even you move to US and become a tax resident, PPI will negate this. So on top of that, okay, if you are worried about privacy, because we all know when we apply for a policy, you have to declare your name, IC number, employment history, things like that. A PPI, once set up, it's set up correctly, can be quite exempt from a lot of data reporting requirements, as well as the fact that being a policy, they won't review information unnecessarily. There's no taxation or very much lesser taxation requirements. Okay, so some cases whereby PPI will come in helpful. Okay, so like I mentioned already, inheritance and estate taxes, these kind of things, when you pass on, the estate assets are transferred, potentially inheritance or estate tax, depending on your jurisdiction. Okay, so in Singapore, like I said, right now, nothing, but we cannot rule out being introduced again in the future. Okay, some places there are gift taxes. When you transfer the gift over to someone who are used to your life, then we give taxes. If your next generation inherits an asset from you and then decides to liquidate, there may be capital gains tax. So all these are scenarios where we call this shrinkage of what you build up over a lifetime, estate shrinkage, if you will. Okay, but PPI will completely negate this if set up correctly. And that is because of some properties which I will go through. Okay, confidentiality as the first thing. So this is where we ask about, can your assets once transfer into, because when you transfer your assets into a PPI, the PPI is a policy, okay? The ultimate beneficiary owner of the PPI may not need to be reported, okay? Whereas right now, if let's say I look at your bank statement, okay, and then this statement is the name of Mr. Tan, I know that Mr. Tan owns this bank account. I know Mr. Tan got how much money. That's if the authorities come to you. But if the authorities go to insurance company and say, what's in this policy? All I can say is, this is a policy, these are assets in it, but that's all. Okay, insurance company may be able to retain the confidentiality of who owns the assets. Okay, so this allows you to ensure that your financial security is not compromised, and yet, okay, because we set it up under a legal insurance structure, you are still in compliance with laws and regulations. Okay, that's confidentiality. Consolidation. Okay, imagine you have many assets in multiple jurisdictions. You have assets in Malaysia, Australia, Singapore, China. How do you consolidate everything into one single structure for management and administration without losing control? Okay, that's a PPI. Okay, you will have oversight and control. And okay, you are saying you maintain the control. And okay, PPI can be set up such that your assets can continue to move to the next generation. And it may not even be in the form of insurance payout. It can be simply transfer of ownership within the PPI. Okay, so kind of like how the policy was, like, you all remember the policy that split into two different policies. Same thing, a sub PPI with a transfer of the asset to whoever you want to own the asset down the road. And because your transfer within a policy is not a payout, okay, you are shielded from a lot of reporting requirements. I know this is all very abstract I would say abstract, but it is a thing that people are using at this level to protect and grow their wealth. And remember one thing, when you set up PPI, given what you put in the PPI, okay, after you transfer it inside, after you set aside what you want to leave behind when you die, okay, you have the power. Okay, so remember, when you buy an endowment policy, the insurer decides to invest in the participating fund, you have no control over the participating fund. But if you set up a PPI, okay, you as a policy owner have enough power because anyway, if they are going to accept a PPI from you, they want to hear your opinions. So in other words, you have become the person instructing the insurer what to do. So that's not the question about what was it? Take care of your asset, all that, right? Uh, I'll just put it this way. So Joyce asked about taking care of assets. If you have a PPI, you tell them what to do, not the insurance company decide for you. Okay, let me repeat. If you have a PPI, you are the one telling the insurers how you want to grow asset. You want to do only FDs? They can do it for you. You want to say 20% do crypto or whatever? I don't really know if they're allowed to do that, but let's say you want a property manager to look after your office building, which you transfer into a PPI, they can do it for you. Okay, you practically own the insurer at this point, at this level, or at this component of the PPI is actually more or less you say you run the show. Okay, so everything inside will be managed by insurer under your direction, not the insurer's decision, your decision, which means in the end, it's still about control. You retain ultimate control in a PPI. Okay, you get to say exactly how it's invested, how you want the thing to be paid out, and how you want to manage or move assets within it. And all of that is under the wrapper of insurance policy, meaning a lot of reporting requirements will be simplified. Okay, these are for people with really big worries about let's just say staying compliant with laws, relevant laws all around. Okay. Not only that, because the PPI may have a cash value. If you need money, you just borrow against it. It's your money anyway. You're just taking your money off from your policy. Okay. And ultimately, when you're gone, as always, remember insurance payouts are tax exempt. So your death benefit is also tax exempt. But on top of the basic form of PPI, there are three more things that can be done. First thing, you can continuously change the insured person. So this is a form of continuity. In other words, okay, as I mentioned, most insurance policy have an end date. Some of them last 300 years, like the policy splitting you see before. But a properly set up PPR can run indefinitely as long as the estate always has someone younger. So basically, you need to have your descendants, but okay, if set up properly, a PPI can basically change the insured person forever and keep the policy running indefinitely. Everything stay within the view of the policy. Second thing, okay, so when you do this, okay, before I move to the second, when you do this, policy become perpetual. Next thing, you don't have any friction losses from things like taxation or liabilities. You just change your insured person to the next younger person, move on, move on, move on, move on. Okay. Next thing, convertible zero cash value. Okay. Now, I don't know how many of you know this, but US citizens can only buy term plans in Singapore. How many of you knew this before I said this? Is this new to you? Anyone you know that actually US citizens can only buy term plans? And the reason for that is because term plan has zero cash value. And on top of that, why is this so? Is because US has, let's just say US tax law is very complex, and if you buy something with cash value, there's a lot of reporting requirements, double taxation agreements, and things like that. So in the end, to simplify things, Singapore insurers only allow US citizens, people with green card, to buy a zero cash value plan. But if for some reason you're thinking of moving to US and eventually getting US citizenship or residency there, okay, then what happens to your existing policies that have cash value? Okay, so the thing about convertible zero cash value just means one thing. Okay, okay, not we lah. The insurance company has the right to set the cash value of the policy to zero, even if there is asset inside the policy. Okay, so how they do that is, yes, there's asset in the policy, but when you surrender, okay, so there's this very specific term called surrender cash value. We can always, or rather, you can always instruct the insurer to say that, can we set surrender cash value to zero so that perpetually you don't have those reporting requirements to US. Okay, so in this case, you do it, then there's no reportable account. CRS corporate, the CRS reporting requirement for taxation becomes one single line, and that also means that you review lesser of your information. So this is very important for privacy. And the third thing is asset exchange. Now, imagine we have two people with PPI. Okay. And then person A and person B lah. Person A want to buy a policy, want to buy a building that is owned by person B, and person B want to and he wants to pay cash for it. Okay. So person B own the building, person A has cash wants to buy. But in this case, the cash of person A is in the PPI, the building of person B is held under the PPI. Ordinarily, if you don't have the PPI, you have to do your usual property agent transaction, then you have your transaction costs, things like that. Okay. If both assets are in PPI, we can do something called asset exchange, which means these people just need to internally transfer their cash and building property over and done. That's it. The building is valued at 25 million. The ownership of the building goes to the PPI under person A, and the ownership of 25 million cash goes from person A's PPI to person B's PPI. That's it. No property agent fee. I think a lot of people will be very happy with that. Okay, not having to pay what 1%, which is still money, right? Okay, so on top of that, if let's say person B is in a jurisdiction where originally his building is 5 million, and then now it's grown until 25 million valuation, and then he want to sell to person A, without a PPI, this 20 million gain might have been subject to capital gain tax. In a PPI, this will not happen if properly set up. So PPI can, well, let's just say it's a very, very interesting tool that people, if set up properly, can use it to their advantage. Okay, now there's a good question. Who had the title of the assets, insurance company or policy owner? Good question. You remember correctly, policy owner ultimately own the policy. So it's in the name of ultimate beneficiary owner is policy owner. Insurance company is only administering for the policy owner. But insurance company may not have an obligation to review ultimate beneficiary owner, UBO lah, as they call it, ultimate beneficiary owner. This is, I think, might be a little complex for a lot of people. So you want to ask about all these, we can take that offline. But I hope that gives you an idea how a PPI is a very unique kind of policy that, let's just say, it has a lot of users lah. Okay, we even see it used to protect prenuptial agreements. Instead of having to write a prenuptial agreement, husband has one PPI, wife has one PPI, so everything stays within the PPI constraint. So you don't even need a prenup. Everything is rock solid protected by a PPI. Don't need to argue who has what asset or things like that. Okay, so that's PPI in a nutshell. One top of PPI can be an entire webinar by itself, but it's not something that I think it will probably cause a lot of headache for a lot of people, because even when I learned PPI, the first time I was exposed to it, it was actually quite a mind-blowing revelation lah. Till today, even PPI, the complexity is even more than is probably greater than anything I ever studied, and yet it is probably the choice, the insurance policy of choice for people who are looking for this kind of discretion, control, and let's just say estate management. Yeah. Okay. Okay. So 4 minutes, I better end off. So the conclusion is this really. Today we learned some strategies. It's not even everything I can share because, like I said, I've run out of time. Okay, but okay, we learn about next generation wealth building and wealth preservation, getting the right policies, CI for your kids, endowment, these kind of things. If you set up properly, can be a reasonable way to ensure that the next generation doesn't face any tough times. If let's say catastrophe were to strike, cancer, whatever things like that, now them they won't be reset back to the Stone Age just because of something like that. Okay, and I think that's very important because honestly, who doesn't want to give the best to their children? We talk about premium financing, quite a fair bit of time spent on that. But premium financing, I think it's very popular, and I believe it will be popular again as interest rate drop, because some of my clients are already getting calls from a bank telling them that, hey, interest rate coming down, we got this deal for you. And I know it's premium financing straight away. Okay. But as I mentioned earlier, you got to set up very carefully with an exit plan. Okay. And this one, really, you have to think through it carefully, work out the maths, sit with someone before you do anything that's premium finance. Okay. Like I said, I've done premium financing before. It's not necessarily a bad thing. It's just how you set it up and ensure that there's always a backup plan. We talk about estate creation, turn to 99 is not something very commonly done, but I would say turn to 99 is actually a very solid way to ensure that the mass market, because remember the premiums don't have to be huge. 10,000 a year is not something that I think is excessive. Okay, compared to say a 2 million premium, 10,000 a year can be used to create 1 million for sure. Okay, and that's asset creation for you. How you ensure that you know that those resources will materialize when you need it. And of course, the most abstract of all PPI, which I know that a lot of you never heard of it before today, know that these kind of things exist, and in the right hands, in the right structure, in the right setup, can be a very powerful tool. Okay, so we used to think of insurance traditionally for protection or hospital plan, accident plan, reimbursement, cancel my mortgage loan if I die, things like that. Okay, but I encourage you to think of it as a tool for guaranteed wealth creation, because insurance is about guarantees, right? Okay, but a policy, you pay a premium, you expect that if a certain thing occurs, you want a guaranteed payout. Okay, so why do we always think of insurance in a way that insurance is for when bad things happen? Not always. Insurance shouldn't always be about something that only comes into play when bad things happen. It can really be for a case where you use it to create more good things for yourself, and even if not for yourself, your next generation. So what I want people to think about is really is on a typical balance sheet for most people, your expenses, your assets and your liabilities, right? And most people think of things like, oh, how's it asset? Cash in bank asset. Investment is an asset. And then my mortgage is a liability I need to pay off. My credit card bill is a liability I need to pay off. My insurance premium is a liability I need to pay off. Stop thinking about, well, no doubt you're paying it off, but is it truly a liability on a balance sheet? Okay. If we can all stop thinking about insurance premium as a liability, but instead think of it as a asset that you have that will come in, that will step in when you need it the most, then that could potentially transform how you see these type of plans and how they can potentially work for you. Because if structured correctly, and the keyword being structured correctly, so you really need to make sure that you sit down with someone and ensure that it's set up in the way that you intended for it to work. If structured correctly, insurance is business continuity capital. Okay, if a businessman falls sick, the company still needs money to operate, but he's the key man in running the business, and he's sick or something, or he's down, or he's dead. What happens to the business? The insurance payout is the business continuity capital. That's how you set up insurance properly. Okay, roof over your family money. Okay, breadwinner dies. What happens to the family? Okay, the family can continue because of a payout. The insurance premium that was being paid by the breadwinner before he died is really not a liability, but it goes towards building the asset that comes in when he's gone, halfway through, unexpectedly or whatever. When he's gone, that asset steps in to ensure that the family continues to have a roof. Okay, when you fall sick, get a stroke, heart attack, whatever. Okay, you've been paying all those insurance premium. It builds that asset that gives you the money to take time off work. You don't have to continue to. Well, I already got this client I met before. She continued working in between a chemotherapy treatment because she didn't have insurance. That's very, very heartbreaking. If she had the insurance, she had the ability to just take 2 years off work and focus on the recovery. Okay. So we need to stop thinking of insurance as a liability, but rather as something that builds an asset, but an asset that is very for a very specific cause to step in when you need it. Okay. And of course, we talked about this already, lah. That was the purpose of today's special extra session, whereby you build the right insurance structures, you can ensure that your loved ones, the next generation, will have all the money, or at least enough money to do whatever they want to do. And for those of you who are looking at estate and tax planning management, then PPI, or even not even PPI, even a well-structured term to 99, or even a single premium whole life, which I didn't have time to cover, can be a estate or tax management strategy to provide the payout tax-free and ensure that your estate is created exactly as you intended when you're gone. Okay, so I think, oh my God, I will run. Sorry. So I think you can tell that there's still a lot more I can say, but in 2 hours, there's only this much I can cover. So although I have a Q&A, but I've run out of time. Those of you who wish to ask me questions, I don't want to hold the rest back. You already have burning question. You can put it here, or if not, you can, well, I suppose reach out separately. Most of you should have my contact. But I also want to say that I have an exam next week, so you want to talk to me maybe after the exam. Okay. So yeah, I'm actually done for today. It's not everything I know, but I think these are the key things that I felt would be pretty interesting to most of you. Okay. Pretty interesting to most of you. And those who don't have my sorry, I'm sick. So you know my number. I put it in the chat. Okay. So thank you very much for your time. Uh, I really don't know what I can say. This is the first time I've actually came up with a presentation. I've talked about leverage before, so I think you all can tell, but this is the first time I come up with a presentation for PPLI and term to 99 specifically. Okay. The rest I covered in some extent before, but I thought it'd be worth mentioning again today. So if you all have no further questions, honestly, I have no idea what else I can say other than most people do think of insurance, like I said earlier, as a liability on the balance sheet. But in reality, done properly, it is an asset that you build for the time when you need it. And it can function so well because it provides the one thing that I think everyone wants, money. Okay. Of course, not talking about PPI. PPI is a it took 2 days for me to learn PPI, and I'm not even done yet. So you can tell PPI can be a 2-day topic, but I'm not going to do that. Okay. So I only give you all the gist of PPI. Just know that such things exist. And if you reach that level where you think a PPI can be helpful, then congratulations, you reached that. You reach that point. Okay. So I'm done. Honestly, really, I'm done. I don't know what else to say, but I hope all of you learned something today. And if you did, just let me know in the chat box so at least I know today, despite my voice and all that, 2 hours is not wasted with all of you, as I always hope it to be. Okay. Yeah. Sorry. Any burning questions? Well, at least you all know PPI it exists. I think that's be the one thing that yeah, also you would not have heard of. So thanks. PPS. Oh, your PPS, what the SQ PPS, SIA PPS. Yeah. Okay. So yes, I am really, really done. I have no idea what else to say, honestly. Questions can be directed to me separately, although as I said, I'm studying for exam, so may take some time to get back. You all can leave, really. I have nothing else to say. Yes, I know. This is reminiscent of the time when I lost my voice during SRS, but it's better because SRS I really couldn't speak. At least I'm still going strong. I only did one break today. Yeah. And yes, Tianan, I hope you did learn some new things. I really just want people to view insurance from a different perspective. Okay. It really shouldn't be a liability. Well, you're paying it, sure, but you're actually building an asset. Okay. You're building an asset. Yeah. PPI. I got a whole book here. I can't show you the title. But now let's just say the examples in this book are pretty uh incredible. Okay, I don't think you all can see the book, so never mind. But yeah, when I first chanced upon it, it's really just let's just say a PPI is something that will not just require me, but require tax accountants, lawyers, and let's just say a lot of people involved to get one PPI out. Okay, so that's as much as I can share. Yeah, that's why I'm going to rest now, as Joyce suggested. Thank you, Joyce. Okay, we're done. We're done. I don't know if Darren's going to stop. Darren, are you there? Okay, I don't know whether he's going to stop recording. Okay, take care of yourself. Be well. Yes, PPI. Yeah, totally new. I expected that. I've never shared it before. This is the first time in 10 years. Okay, we're going to end the session. Thanks. Take care, and questions can be directed to us separately. Good.